Look, I think the Gulf states have been preparing strategically for a post-petrodollar world. They have understood for quite some time now that the foundations of their recent economic wealth, oil, is not going to be playing as significant a role in 20 or 50 years' time. And if they are to maintain their quality of life and their economic and social welfare, then it's vital for them to begin putting in place the building blocks that enable them to, in a sense, build off or transcend the limitations of this particular economic model. So, what this model has enabled Gulf states to do over the course of the last 3 to 4 decades is accumulate US dollars, of course, and recycle those US dollars into American securities, financial debentures, and also, of course, into purchasing technologies and other things from the United States. And what we saw in the recent the Gulf trip by President Trump in terms of this question of the investment dividend is really a logical extension of the need for countries that have accumulated US dollars to recycle them into other things. What's interesting about this particular set of arrangements and agreements is probably three things, I think, Lena. One is that many of them are quite open-ended MOUs, so they're not really locked in contracts in some of the areas. The second thing that I think is interesting is that, in fact, these are forward-looking agreements that really go to what these countries intend to do with future US dollar earnings, because they certainly don't have those liquidity reserves today to be able to meet the kinds of obligations that they have indicated that they are willing to do. But I think the third thing that's probably the most important is that these intentions expressed by these agreements is that the Gulf states are essentially saying, we don't want your paper, but we'll take your things. We will take whatever it is that you've got that can tangibly be located within our areas of influence, our own countries, because the last thing we want to hold on to for the long haul is more paper. So American IOUs in the form of US dollars or various forms of financial derivatives are no longer as attractive a prospect for countries that have significant current US dollar reserves or anticipated US dollar reserves. So the Gulf state transition is to accumulate whatever they can from a technology point of view that can help them in progressing their strategic objectives, which is to lay the groundwork for a post-petrodollar world. And that's what I think is actually going on at the moment. So yes, the Gulf, should they have significant US dollar reserves, will need to recycle them. And they will take whatever they can that can be located in the Gulf states. But ultimately, the long haul game is to deepen and diversify the economic relationships that they have with other parts of the world, because the post petrodollar world is a world of diversity.
The key theme of the summit was trilateral cooperation, as you just mentioned, in trade and in investments. And if we look at, if we look at each individual party, this does appear to be an ideal match. The Gulf has substantial financial resources. China has unparalleled modern manufacturing capabilities, and of course, ASEAN is an extremely it just has that momentum, and it's definitely the growth, and the market is very, very promising. So these are very complementary things that all of them bring to the table, and it is a win-win. How might this stronger cooperation framework and stronger ties among these actors redefine global economy and maybe multi-currency structure and frameworks?
Look, there's been a few things happening over the course of the last few years, which I think feeds into precisely what you're getting at here. We know, for example, that UAE and Saudi Arabia and China have been involved in a project, Enbridge, which has been looking at technologies that support national currency-based trade settlements. We also know that China and ASEAN have for a number of years been building the infrastructure and the agreements necessary to also expand the role of national currencies in trade settlements. And in fact, in the days leading up to this summit, the People's Bank of China and Indonesia's central bank executed an MOU to agree to move harder and faster to to accelerate the use of national currencies for trade settlements between Indonesia and China. Now, this bilateral question is significant in and of itself because we're talking about trade values of about 150 million US dollars equivalent, where Indonesia actually has a modest surplus, which really means that the trade dynamics between these two countries are relatively equivalent. And so settling trade in national currencies is comparatively easy to do without creating any systemic and structural balance of payments problems. So we've got a few things coming together now, which is a technology layer. And let's not forget, some of these nations are also members of BRICS. So Indonesia is a full member of BRICS. China, of course, is a founding member. UAE is in BRICS. Saudi Arabia, I think it's fair to say, are sufficiently BRICS friendly, even though their formal status seems to be something that people debate a little bit about. Malaysia, of course, is a BRICS observer or partner nation. Vietnam is too. Thailand is too. And so we can see a multi-layered set of institutions coming together that aim to promote growing openness in not only trade flows, but also investment and people movements. You might also note that off the back of this summit, China announced the addition of the remainder of the Gulf states that weren't part of China's visa-free program to now be able to go to China visa-free. So these multi-layered networks of institutions aim to enable easier flow of economic value and for this economic value to be denominated and settled in the national currencies of the participating nations. There's no doubt that what's going on will hasten the ability for national currencies to play a more prominent role in trade settlements going forward. And one of the reasons for that, Lena, is that the more players you've got involved, the more complementary their trading relationships are, the easier it is to enable national currencies to work because you don't have any structural or inbuilt balance of payments risks. You know, countries literally have sufficient counterparty currencies to be able to settle their trades. You have balance of payment problems when one country accumulates a lot of another country's currency, and of course the other current country doesn't have enough counterparty currencies to settle trades. Then you've got some challenges. But the more players you get, the more trading pairs in effect you get within a set of institutions, the quicker and easier it is to move from having a single denominator that speaks as a common financial grammar, if you will, for participants to one in which national currencies will become just part and parcel of daily business.